Monday morning, and Wall Street had a very, very nasty Friday, which hardly anyone is talking about. It's kind of like, almost like it didn't happen from most of the media headlines, but it certainly did. And it wasn't as big as the crash we had a few weeks ago, or a couple of months ago, but it was certainly significant. And closing on its lows the way it didn't look good. I did an AusBiz Australian TV show on Friday afternoon, and I pointed out that the price action of the previous trading sessions was pointing to some potential overhang by those big three super funds to just come into the market now and begin selling. And I think that's what's happening. I don't think it had anything to do with the job starter. I think job starter is highly overrated. I think the Federal Reserve agrees with me on that and really doesn't have much of an interest in terms of any short-term decision making, maybe long-term trends only. So it was really about, I think, those big three funds, BlackRock, etc., Vanguard, First Street, First State, whatever it is. I'm just starting my coffee. They were waiting, hopefully, for a rally to offload on that job starter number. They didn't get it, so they began to pile in with their selling orders. And I think we're going to see what I spoke about a couple of weeks ago, is that within these big funds management organizations, various, because there's thousands of people managing money within these organizations and their expanded sort of portfolio distribution. So they're going to begin to compete with each other on not losing as much as the other guy to get the biggest bonus, or to maybe make money on the downside being short. They don't have many short selling funds in those big organizations, but they do exist. But it's more going to be about, you're going to get a bigger bonus at the end of the year if you lost less or half as much as the next guy in a bear market. And that means moving your funds into cash. And I think really that's what we're going to see over the next coming days, this week, month, maybe the rest of the year. Federal Reserve's about to cut interest rates. Now, why that's important is that usually rate cut cycles can coincide with bear equity markets. I mean, it's a complete nonsense. Everything that you've been taught about interest rates determine equity values is completely false, because often equities and interest rates are responding to the same stimuli in real time, that is the state of the economy. Now, the US economy just printed 3%, but it's not that strong really. It's a lot of government spending in that. So I think if the Fed is cutting rates, it's only because it's deeply concerned about the economy, and that should be a concern to any investor or trader out there, that the Federal Reserve thinks the US economy is in trouble and it needs to cut rates, even though inflation is above the band still. Obviously, inflation's improving. I think the Fed should be cutting. They should have already cut. I think the RBA should have already cut 3 times. Please check out my website, cliffordbennett.com.au, for everything I have to say about the Reserve Bank of Australia at the moment. You might find it quite interesting. My Sky News interview, my AusBiz TV interview, and I'm going to put some more stuff up there today as well. What I'm trying to say to you, but trying to give it some substance, the US stock market looks very ugly right now, and if I were you, I would be hedging. I'm short. You don't have to be short, but protect your portfolio. Hope you have a good day.